What's up, everyone? It's Kadi with MoneyVest. So in this video, we are going to be talking about Magnificent 7 companies all together. And this is going to be a full technical analysis on these companies, as well as an analysis of their fundamentals. We're going to break it down in this video. As always, if you enjoyed, find it helpful, make sure that you drop a like. And of course, don't forget to subscribe to the channel if you're just joining us for the first time here. And the link to our Discord and Patreon, of course, is going to be down below if you're interested in joining us. And of course, getting access to all the members-only private videos, all the trade alerts through our Discord channels, all the TradingView charts, my actual charts that you can copy, and of course, the watch list, as well as over 46 private members-only videos, and of course, the MoneyVest.com website that's going to be launching very soon. My handle on Instagram is going to be CastWRP. Feel free to connect with me over there as well. So, Magnificent 7 is what we are doing the comparison on. This includes your Meta, Amazon, Apple, Netflix, Google, Nvidia, Tesla, and Microsoft. So all these companies we're going to take a look. So on a year-to-date basis, you'll notice that the best performing stock should not come as a surprise. Of course, it's Nvidia, up a little bit over 76% right now, followed by, surprisingly, Meta. Meta pushing up over 42-43%, kind of carrying forward that momentum from last year. And at third place, it's not Apple, it's not Amazon, it is not even Microsoft, it is Netflix. And Netflix kind of seems to be a little bit of an underdog this year. Was not the best pick, was not the most covered stock going into the year, but seems to be performing really well, up over 24/7. Actually, it should not even be a part of Magnificent 7. I don't know why I have Magnificent 7 here, but I still have Netflix. It's part of FANG, but it's not part of the Magnificent 7, because Magnificent 7, of course, the market caps are much bigger, but we're not gonna be rude to Netflix today. Just because it's here, we're going to cover it anyways. A 24% growth. It was supposed to be a FANG analysis plus a Magnificent 7, I guess. So a little bit of combination there. But 24% gain here for Netflix. Very nice. Now, we do have Google down on the year, 3%. We do have Apple, obviously down over 11% this year on the back of some very, very concerning data that's been coming out of China. Warren Buffett selling as of the fourth quarter 23. And then, of course, my biggest position, Tesla, also struggling, down over 29%. So definitely having one of the worst starts to the year, down almost 30%. Microsoft is up a decent 8%. Amazon is up twice that much, almost at a little bit over 15%. So overall, we are seeing some very good performance from Nvidia, Meta, kind of carrying forward that momentum. Amazon and Microsoft, of course, pushing up. But of course, Apple, Google, and Tesla struggling a lot at the moment. Now, if you come down, let's just start with the growth. Now, when it comes to growth expectations, it's going to be quite stable for Apple, Meta, and Google and Microsoft. So those are 4 companies where I expect the growth rates to be a lot more stable. So you can see that Apple's growth rate, revenue 3-year CAGR 9.46%, 5-year just over 8%. Forward growth rate for actual earnings is expected to be just a little bit over 5.3%. So quite low growth. So Apple would be considered as a slow growth stock, because Apple, most of that gain for the earnings per share, the bottom line, has come from one stuff, and that is share buybacks. Their financial engineering with respect to share buybacks has really been one of the reasons why Apple has been able to grow earnings as fast as it has. Net income wise, it's been in the high single digits. If you come over to Google, we're looking at a 19, almost 20% growth rate. Then we're looking at a little bit over 10% growth in the revenues on a forward basis. Then, of course, if you take a look at EBITDA growth on a forward basis, 12.5. So again, we're working with about 10 to 12% growth in revenue and EBITDA and earnings. And profitability-wise, bottom line, earnings per share expected to grow at 19%. Microsoft, also very similar numbers, about 12% growth in revenues, almost 22% growth. Actually, that's going to be 14%. So yeah, 14% growth in EBITDA and bottom line earnings. And then we've got about 11.4% growth in actual earnings per share on a diluted basis. Tesla's even lower. That's 1.7%, by the way. That's one of the reasons why the stock's been selling off, because earnings expectations have really been dropped down. They've been revised down. In fact, one of the analysts even cut down earnings per share expectations by 25% for Tesla, and even cited that there's concerns that the company might actually turn a loss this year, might actually be turning the corner towards generating a loss, and that's the last thing we want to see. And I've already done a couple of videos on Tesla in more detail, so definitely do check that out. But revenue growth expected at a little bit over 17, almost 18%. Delivery expectations of well over 2 million, of course, as we are looking into 2024 and beyond. And the highest growth rate companies, of course, are going to be NVIDIA. NVIDIA at over 69-70% with a 54% growth on a 3-year CAGR basis. On a forward basis, we're looking at, again, 69% with bottom line earnings expected to grow at a very nice forward basis of 106% here. And of course, year over year, we saw 585% growth here for NVIDIA. That's one of the reasons why it's doing so well. And Meta is also performing really well, 73% growth on earnings per share. Bottom line, 39% growth on a diluted basis, on a forward basis. And then we got revenue forward at over 15% and 3-year CAGR, 5-year CAGR at 16 and 19% respectively. Now, Amazon, I feel like, is one of those companies that is still under the radar. Now, I talked about Amazon as being one of the higher growth companies because it is just now starting to focus on profitability. And that's actually one of the reasons why I feel that the long-term CAGR on the growth rate is going to be much higher. Revenue is only at about 11.6%. That's fine. EBITDA at over 27%. You'll notice that EBITDA for Amazon is actually higher than Apple, Netflix, Google, Tesla, and Microsoft. Why have I in the past favored Amazon more than those 4 companies that I just mentioned? I would put Amazon as the as the second highest growth company next to NVIDIA among the Magnificent 7, by the way. Amazon, in my opinion, is actually one of the most overlooked Magnificent 7 companies because everyone likes to flood into Apple. Everyone likes to flood into Microsoft. Of course, Tesla, NVIDIA have their popularity, and Google and Meta are kind of like in the comm services sector, and Meta having one of the best years so far in 2024. But Amazon, I feel like, has been one of the most overlooked Magnificent 7 companies. I've been talking about this for years and how their advertising business is absolutely going to crush that of YouTube and of that of Meta's social media as well. So Amazon, in my opinion, is only getting started, has a ton of potential for profitability, not for revenue, not saying that it's going to grow revenue, but I actually do believe that earnings per share, the bottom line profit, is going to be an engine for Amazon to drive future gains. And that is why I do believe that Amazon has more potential than Meta long term, has more potential than Apple and Google and Microsoft, maybe even Tesla, but Tesla is a whole different story. It's not exactly comparable to that of Amazon. Amazon's comparable because it's got advertising and cloud and hardware and a lot of the businesses that kind of overlap with that of Netflix and Google, and it's even got streaming. So there's a lot of businesses within Amazon that compete directly with that of Meta and Google and Microsoft and of course Apple here and Netflix. So Amazon's like one of those companies that competes with everyone in this space except for Tesla, because Tesla's a whole different story. Now coming over to the valuation. Profitability wise, again, we've already looked at, separately into these companies. 80% gross margins for Meta, very, very high. 47% for Amazon, 45% for Apple, 41% for Netflix, 54%, 57% for Google, 72% for NVIDIA. Tesla, obviously, again, a whole different story. Electric vehicle manufacturers, 18% and 69% for Microsoft. So all of them being tech companies, very, very high. Honestly, I feel like Tesla should not even be included in this right now because it is not a tech company. According to my analysis, it is still an electric vehicle business at the moment. But this is, again, part of the Magnificent 7 analysis. And Tesla is still, I think we should keep it. We should keep it. We should not be rude to Netflix and Tesla here right now. Now, if you come over to, and again, bottom line profit margins, 29% for Meta, really high. Amazon, still lower, but they haven't been focusing on net income. That's what I'm saying. That net income wise, 5.29%. Really, really low, but if they wanted to, they can really accelerate this number to 10, 12, 15%, and imagine what that's going to do to earnings per share expectations. Apple at 26%, also pretty solid. Netflix at 16%, Google 24%, NVIDIA incredibly high, almost half of their revenue turns into profit, 15.5% for Tesla. Now imagine, right? Tesla's 15.5%, Amazon's 5.2%. Tesla is already a very, very hardware in capital intensive business, and it's still doing over 15.5%. Amazon's 5.29%. You really think that 5.2% is lack of profitability? No, it's lack of focus. And the moment the company shifts and turns that focus to profitability, that number, I can tell you, over the long term can easily be well over 10%. It's going to more than double in terms of profitability here. And Microsoft, we're looking at 36%. So again, all companies are profitable. If you come down on the balance sheet, everyone's carrying net debt except for Amazon, which is at over $74 billion, but every single one of them, except for Netflix also. Actually, you know what? Yeah, this may not be the perfect analysis because the companies do carry a lot of marketable securities, which may not be, so that's not included in the overall analysis here, because the companies do carry a lot of long-term assets or non-current assets as part of marketable securities and US Treasuries, which this analysis is not including for. So I think a lot of them are already Apple, of course, we already know, more cash than debt. Meta, more cash than debt. Google, more cash than debt on the balance sheet. Even Microsoft, more cash than debt on the balance sheet. And then we got Tesla here, again, negative net debt. And I also feel like Amazon has more cash than debt on the balance sheet as well. Every single one of them has good current ratio, low debt to free cash flows at closer to 1.5, 2, 3. Tesla's a little bit higher, 19.2. And of course, we got Amazon at over 7 as well. Now, let's talk about valuations, folks. And this is where things are going to get quite interesting. And I want to hear from all of you. Participate in the comment section down below. When it comes to valuation, we're looking at Meta at 24, 25. In fact, on a forward basis, we're looking at 25 to as much as 34 on a trailing basis. Amazon obviously much higher as well because of the lack of profitability here. Apple 26, 26, 26. We got Netflix at 50, 35, 50. Google at 23, 20, 23. Nvidia 67, 38 on a forward basis here. On a gap basis. Tesla 76 because of lower earnings expectations, and Microsoft at 34. Okay. So of all the valuations over here, surprisingly, Nvidia makes the most sense because 38 times based on another 90% growth in earnings per share. I can't believe I'm saying this, but I actually do think that Nvidia has the best valuation here because if you come take a look at the PEG ratio, so PEG non-gap forward ratio here, 1.23 for Meta, 1.72 for Amazon, Apple at 2.77. So you can completely disregard Apple here at this valuation because based on the growth expectations, Apple is actually not worth trading at this premium. It's just not, it should not be demanding this such high premiums here. 1.2 for Netflix, quite reasonable. 1.22 for Google is actually quite good. Tesla's 2.89 because earnings expectations have gone down so much. And since earnings expectations for Nvidia have gone up so much, take a look. 1.2. It's the lowest among all Magnificent 7 companies. Microsoft's at 2.3. So I feel like both Apple and Microsoft, as I've said this before, I've said this in my multiple videos, both Apple and Microsoft trade at a little bit of a premium relative to their valuation and their expected growth here. Google is one of the more reasonable stocks, trading at around 20, 25 times earnings multiple and 1.2 times PEG. Even Meta, after the rally, based on a PEG ratio basis, it's quite decent, 1.23. But on an absolute basis, the valuation at 25 to as much as 34 on a trailing basis still could be argued as a bit more expensive. But surprisingly, Nvidia, man, it is just insane how even after the surge that we've seen of almost $1,000 per share, the PEG ratio is still at over 1, just over 1. And again, we have to understand that this is happening because earnings expectations have gone up and down. So, you know, what really happens at the end of the day is like, if I could just tell you and kind of draw for you in this fashion here. So Nvidia earnings expectations gone up. Tesla earnings expectations gone down. Microsoft has been flat, but the earnings expectations are actually quite low relative to the price that it's trading at. Price is high. Earnings expectations are low, and as a result, 2.3 is the PEG ratio. Google earnings expectations are again flat. Price has actually come down. So again, earnings expectations are flat to slightly down. The PEG ratio is 1.22. So that's where we are at the moment. So, and then if you take a look at Netflix, we are looking at around 1.2 PEG ratio, which is again, earnings expectations are quite flat and slightly down, and price has been rallying a little bit higher. So actually the earnings expectations are a little bit higher and the price has also gone up. So 1.2 is also quite reasonable, quite well. For Apple, is the same story as Microsoft, as the price has been pushing higher than the all-time highs. Just recently, it's been coming down, obviously. And then, of course, we've had the earnings expectations that are low because the growth rate is not that high for this. And as a result, we're working with a 2.77 PEG ratio. Amazon 1.72, quite reasonable, 1.23 for Meta. So of all the companies that we're looking at, Nvidia surprisingly makes for the best potential deal on a PEG ratio basis, but I would still not be willing to pay such high multiples, and even at these prices, considering that technicals are very, very overbought. So it's one thing about looking at the fundamentals and valuations. It's a whole different story looking at technicals and how overbought it is. So it does carry some short-term risk considering how overextended the chart really is. Microsoft and Apple would be a big no at these prices. Google can be a maybe, Meta can be a maybe, and Amazon would certainly be a buy sub 150. Again, we're looking for better PEG ratios. And Netflix, they just carry a little bit too much debt, and they're looking at a very, very significant amount of cash burn. And for that reason, Netflix is also out of the picture, at least for right now. And Tesla expectations need to improve post 2024 going into 2025. And that's when we can expect a lot of potential growth and acceleration in the price here. Price earnings multiple is going to come down. And the PEG ratio is obviously going to be a lot better than where it is right now at 2.89. So that's going to be the entire analysis on Magnificent 7 companies. We're going to be doing a separate, more detailed technical analysis on these stocks in another separate video. So hope you all enjoyed it, found it helpful. Make sure that you drop a like. And of course, don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. And as always, happy investing. I'll see you all in the next video.